But trust me, if you need any support, just let me know, and I will make that happen for you. Okay? And it is whenever I teach, I make full commitment to my teaching, and you will find the benefit of that. Now, I have consultation hours on Tuesdays from 11 to 1. If you cannot make it into this specific time, you can just drop by my office, but there's a good chance that I'm not there, so better to make an appointment by email. If you want to make sure that you can see me in my office. Is that all right? Just make an appointment, send me an email, and I will let you know when we should meet. Of course, like I said, you can drop by anytime if you want. Okay? If I'm free, I'm happy to talk to you on any issue related to this unit. If I'm busy, we can sort out a different time. Okay, and basically at the moment I'm located in the Department of Economics. I'm a senior lecturer in the department for the information. All right, and the plan for today is the first lecture. We're gonna go through some important stuff related to administration and assessment. Right, I just want to let you know everything up front regarding the best approach, how to study this unit most productively, and how to get a good mark at the end of the trimester. And then we go to topic 1. Okay, and we have 7 topics for the trimester. Today we will complete topic 1, which is a short one, very much an introduction. Next week we will go to more, interesting stuff. That is the plan. And my style, I hope it will work for you, is that we're gonna go for about, we have 3 hours or not, right? Almost 3 hours. So we're gonna go for about, let's say 1 hour and 20 minutes. We take a short break, 10 minutes break, right? And then we get back with the remainder of the lecture. If it doesn't work, we can work out an alternative arrangement. Okay, but for now, let's stay with that plan. Any quick question before we begin? Good. So, and by the way, all the resources, all the documents that we are talking today can be downloaded from the UNIS website. If you log into Cloud Deacon, okay, you can download all of these materials. So we have one on-campus offering only, and make sure that you note the time and attend the lecture on a regular basis. It is important from my experience, right? Especially with students who achieved a good mark, a good grade in this unit. They attend the lectures on a regular basis. So the benefit is obvious, right? You save a lot of time, and you can interact with me, you can ask questions, you raise concerns, or you can discuss the contents, right, as we go. So it's better comparing to, leaving everything toward the end of the term, right? It might be too late. Okay, and there will be class recordings as always, and that will be published as soon as we finish the on-campus lecture. So I'm planning a minimum of 3 live Blackboard collaboration sessions, right? And the main purpose is to assist with those who do not have the time to attend the regular lectures, or for some reasons they miss out on some important stuff. Okay, they want to catch up within a short time period, all right? And I'm going to plan it throughout the trimester. We have the minimum 3 of them, all right? And towards the final exam, we might have 1 more, depending on how we go. Okay, and the exam for this unit, right? So just by the way, because of my committed activities towards the end of the trimester, we will likely, I don't know, right? Because the exam will be set by the university. but I have made the case that this unit is an important unit. Okay, it is not easy to get a good mark if you don't work hard. So we should have an early exam. Okay, so but like I said, it is what I proposed, and the university might put it at the end of the exam period. Who knows? Correct? But just keep that in mind, and I'll let you know as soon as I have the confirmation. Okay, so the text for this unit, International Financial Management, and we are having the 8th edition of the text. Make sure that you have a copy. So on the website of the unit, I get back to the website in a minute, but you have a few options, right, to obtain a copy of the text. You can buy a hard copy, and you can later on resell it when you complete the unit, right, to students in the future trimesters. You can also buy an e-book version, right? Or you can go to the publisher's website and buy the so-called Connect package, okay? Now, just keep in mind that the hard copy will stay forever, of course, right? But all the online resources associated with the publisher, right? They have a specific 180 days access only. Keep that in mind, okay? If you stay with the e-book or the Connect version, for instance, the access will expire after 180 days. Okay? And the benefit of buying the hard copy is that you also have access to the online portal. You can read the book online as well. Okay, and all other materials will be provided on Cloudican. Am I right? And I will show you in a minute, but we designed the website in such a way that you can access the documents in a fairly straightforward manner, right? It's going to be topic by topic. And lecture slides, the most important ones, I believe, will be released on Mondays. Well, I'm going to make it Fridays, okay, of the preceding weeks, so that you can have early access to the subsequent lectures. Okay? So by Fridays, not Monday, because we have Tuesday lectures, right? So it's better to release them early. So Friday before the lecture, you will be able to download the lecture slides. And please make sure that you check Cloudican on a regular basis. Okay? Because from time to time, we will provide important announcements, right? And something might be related to, for example, assessment. And that's going to be important. Other resources for the unit, and you will see them from time to time again, especially in the period of working on the assignment. But the idea is this one, right? So from our experience, right, you might want to take a look at this, follow the relevant links, and you can you can take a look at the contents of this website. The first one, BIS, is the Bank for International Settlements. It is also called the Bank for Central Banks, right? It is where central bankers, they discuss policy issues, right? Of course, we have the IMF's website. It is more formal, okay? Because we all know that IMF is responsible for the balance of payments, right? It is going to make sure that all countries, they follow the same procedures, so that all the transactions would be recorded correctly, okay? It doesn't matter which country you are located, right? As long as you have an international transaction, there could be a subsequent entry for the other country, okay? So it is a double entry accounting system, by the way. The World Bank is also useful because from time to time the bank provides very much development loans for developing countries, am I right? And that might impact the financial market in a very significant way. And of course, the central bank's websites, in particular the RBI's website, okay, the Reserve Bank of Australia, given our location. So from time to time, and RBI is also a very good example when you talk about monetary policy, correct? So from time to time, I tend to use examples coming out of the RBI's website. In particular, the cash rate decisions, right? The cash rate decisions. It is important, right? And in the next couple of weeks, when we talk about the effects on the financial markets, right? You will see that it is a very, very important indicator, right? The market will follow the RBI's decision, right? Very much. Okay, and we have a lot of news resources, right? And this is just a short list, right? With the technology development, you might have a lot more, and you are free to use any online resources as long as they are helpful for your study and also assessment, the assignment in particular. We have Market Watch, right? Among those news resources, Market Watch, it is useful because they provide somewhat most up-to-date news and information about the global financial market, right? And they have headlines, whatever, some lead in the article, in the news article, so it can save a lot of time. You might want just to take a quick look at the headlines and the leads, okay? Okay, Daily FX is also useful, so they provide live news when they become available, and also market data. They also have a very powerful financial calendar, okay, and that is important when you trade currencies. Eventually I will show you what you need to do for the assignment, right? But when you trade currencies, the market calendar is very, very important, okay? You want to see what's going to happen in the next 24 hours around the world, in the next 7 days, in the next 14 days, right? You can keep track of those news so that you don't get big surprise when you open the trading platform, okay? And the trading platform that will be used for this unit is called Easy Markets, right? It is one of the many available platforms that allow currency trading. So you can trade currencies. There are more than 20 currencies, I believe, that can be traded freely on this platform, and we're going to use this platform for the purpose of the assignment. So what's going to happen? You don't need to do anything, right? Just wait until end of March, end of this month, and we will provide you with the login detail, right? With the personal login detail. You can just go to the website, log in, buy and sell currencies, that's all, okay? That is the idea. And the benefit of using this platform is that you can trade like very much a real forex trader, okay? So all the functions will be very, very similar. But anyway, it's a bit early, so don't worry, it's going to be fun, am I right? That is the main thing. Nothing difficult. Just log in, the same way log in your email address and hit buy or sell button, that's all. If you do that, if you perform that activity 12 times, well, so the idea is that you open the position, right, and eventually close it before the due date. You need 12 positions, right, to complete the assignment, a minimum of 12. As long as you have 12 positions, you are done, very much, am I right? You qualify for what we call the ranking scheme, and you will pass part A of the assignment. Okay, part B is all about analysis, you know, news collection, and so on. Okay, so it's going to be very, very easy, and students in the past, they love this component of this unit, so, and I'm sure that you will like it. The last dot point is a document prepared by me a few years back, a little bit dated, but anyway, so the idea is that I just want to give you an overview of some of the performance of some selected currencies, right? The most frequently traded currencies in the world, including the Australian dollar, okay? You will see the performance of the currency in the last 20 years, I believe. Okay, so if you want to have a quick look at the history, then the document is available on the website, and it is prepared by me with the assistance of one of my PhD students. All right. Now, the last thing for this particular set of slides, very important one, assessment. So assessment for this unit will consist of one assignment only, just one assignment, and the final exam. The assignment is worth 40%, and the final exam 60%. Okay. Now that's a hurdle requirement for the final exam alone. It will need to achieve at least 50% of the marks allocated to the exam. Okay. So if the exam is marked out of 60, you need 30 to pass. Okay, 30, and 30 is easy. Okay, 30 is very easy, provided that you work hard. Okay, if you don't work hard, you wait until the very last week to jump on board, I don't think it's going to happen. Okay, so make sure that you keep track of this unit on a weekly basis. You follow the lecture contents, and I'm sure that it will happen. Now the assignment, it is worth 40%, okay, and it has two components. Right? The first one is what we call an internet forex trading game, right? Currency trading game, and it is worth. So the point allocation is this one, 15 points, right? And the second component of the assignment is the report, and the report has 25 points, a little bit more important. Okay. Now, how to pass the first part of the assignment? Like I said, right, it's very easy. Just log in your account, right, and trade currencies. As long as you have 12 positions opened and closed, you can just open and close immediately. Why not, right? And you complete part A. You get at the minimum 8 out of 15. Okay, minimum 8 out of 15. Now the problem is part B. Okay, part B of the assignment is a report, and that requires a lot of activities to be taken, right, in part A. If you don't have that many activities, you cannot write a lot in part B. Okay, and if that is the case, you are not likely to get a good score for part B. So part B will be based on the quality of the report. Okay, and it is linked to part A. So by the way, we are talking about the assignment, so let me just bring up the assignment. Actually, I want to get back to the assignment around week 3, right? Because in week 4, end of week 4, we will provide the accounts. Okay, so week 3, we'll get back to this document, but today, I just want to show you briefly what it is and what you expect to do in the next few weeks. So the assignment, again, it is due in week 9, okay? It is due in week 9, and it has got 40% of the total grade in it, so it is important, okay? So there will be 2 parts in the assignment. Part A, the internet trading game, am I right? We will provide you with a personal demo trading account so that you can log in to the platform and trade currencies. Okay, and it is too early to do that. All right, we will provide you with your account around the last week of March, right? Because now, if we provide the accounts, you don't know what to do. Well, many of you are expert, I know, but many students might be new to this kind of system, right? And they might lose a lot of money. So that is not fair, we believe. So we will provide the accounts when the time comes, okay, around the last week of March. And then when you open the account, you will see that the account has got $50,000 in it, okay, $50,000, a lot of money. The bad news is you cannot take that amount out, okay, you cannot withdraw that amount. they stay with the platform. Okay? So they are the virtual money, not real money. So all you need to do is to make the amount grow. Okay? By buying and selling currencies in order to take profit from the market. Well, profit is what we want to see, but from time to time, depending on the market conditions, right? You might lose a lot of money, some money, not a lot. But if that is the case, that is okay. Okay? Making profit here is not easy, am I? It's not easy to make money in the forex market. It is likely that on average, students will lose some money. Okay, so don't worry about, how do I make money? How do I make profit? Okay, you don't have to make profit. Okay, as long as you can maintain the account balance at the very end from the past performance by average performance by students taking this unit, it will end up with a very good score. Okay, so that is the idea. So don't worry about, I have no knowledge in this market. How do I make money? So don't worry. Okay, so don't take a lot of risky positions, and you should be okay. And the game is fun, and like I said, you don't have to do anything right now. Okay, just wait until end of March when we send you the accounts. You can start, this component of the assignment. So you don't need to go to the website and apply for an account. You don't have to do anything. Okay, you can go to the website, have a look if you want, or do nothing between now and then. Okay, just wait until end of March. Because even if you register for a demo account with the website, we are not going to mark that your performance based on your personal account. Okay, it's not part of the assignment. The assignment is such that we provide everyone with a similar, very much the same account. Okay, of course different personal account, but the account setting is exactly the same. Okay, everybody is going to start with the same amount of money, same time, and we finish at the same time. Okay, it's a fair game for everybody. So if you want, you can go to the website, have a quick look for now, but you don't have to do anything. Okay, just wait until end of March. All right, and keep in mind that it is a risky, activity. I mean, trading currencies. So from time to time, you might lose a lot of money. That's fine, but don't get into a situation when you run out of funds in the account. Okay. You have $50,000. That's a lot of money. You can trade $500, right? You can put $500 for a particular trade, so you can do a lot of trades, am I right? Don't put $20,000 for a particular trade. You might lose it in a few seconds. Okay? So that is, and don't worry, it's early. So like I said, in week 3, I get back to this assignment document and I explain the details. Okay? Now, for right now, I just want to bring up this note, right? This disclaimer. So we are not going to take any responsibility for the trading behavior. Okay? Whatever you do on the platform is for the purpose of the assignment only. So if you decided to go with an actual account, right? If you open a personal account to trade currencies, we are not going to take any responsibility for that. You might find that if you have the talent to make money here, right? And that is our personal situation. We are not going to take responsibility for the behavior. Okay? So all we want here is that you know how currency trading works. You have an exposure to the market, right? Using the very much a live account, and then you can take profit and you can manage risk in the market. Am I right? And we believe that it is a nice way to study, right? We talk about forex market and we don't know how it works. Then it's not going to be fun. Okay, and this is the ranking performance. So sorry, the ranking scheme for the students who have done 12 transactions or 12 trades by the due date. Am I right? As long as you have 12 positions open and closed, it will qualify for this ranking scheme, and you are guaranteed with at least 8 out of 15, okay? Very lenient. 8 out of 15, so you pass part A, no matter what, am I right? It doesn't matter how much money you are making, you will pass part A. As long as you have 12 positions or more. Of course, you can do more. You can do 20 positions. You can do 30. It's up to you. Am I?
Is it valid if you open an account, the kind of gain like 5% or 1% gain and then you close the account?
So it's early to talk about the details. Am I? The details of the performance. But the idea is that this is a demo account. Am I right? That works like a real account. So all we want to see is that you have traded some currencies. That's all. Okay? You make money, you lose money, not a big deal. As long as part A is a concern. Okay? As long as you have 12 positions, you will be guaranteed with 8 out of 15 for part A. Okay? You don't have to. You don't need to make money. Okay? You can, like I said, to qualify for this thing, right? You can open a position and close it immediately. You can lose a few bucks, that's fine. Doesn't matter, okay? But you have nothing to write in part B. That is the bad news, okay? So don't worry, I get back to the details. And I show you some strategies to go with this component. Okay, and the top performance is, of course, 15 out of 15. And we tend to get 3 perfect scores for part A of the assignment. And then, 13.5, 12, whatever. If you look at the ranking scheme, from 12 up, right, we have a lot of students. So you are likely, many of you will end up with high distinction for part A, right? But part B will require some work. So part B is a report, okay? You need to spend time to collect information, to gather news and announcements in the forex market, in the financial market, that support the trading behavior, am I right? If you decided to buy Australian dollar against the greenback, the US dollar, today, for instance, right, you have to tell us the reason for that behavior, am I right? You cannot say that, well, I like the Aussie dollar, that's why I bought some of it. It's not going to work, okay? We need a solid story, okay? And how do you end up with a solid story? You need to gather the information, okay? Take a look at news, announcements, whatever information that can support the behavior, okay? And the harder you work, the higher mark you will end up with. That is our guarantee. Okay, and the other stuff, they are just, the procedures that you need to follow. And I get back to the details before you submit the assignment. So the idea is that you need to download the trading positions, the activities in the market so that we can have a look at what you have done during the assignment period. Okay, and this is a marking table, the rubrics table. So it is out of the maximum score for part B of the assignment is 25. And we allocate them according to this criteria, okay? You might want to take a look when you have the time, and I will explain them before you start the assignment. So just keep in mind again, for now, that you don't have to do anything now. Just wait until end of week 4, okay? End of week 4. End of March, same time, we will send you an email with the login details, okay? Between now and then, you don't have to do anything. So you can enjoy, other stuff in this unit. But of course, if you are curious how the market looks like, you might want to take a look, right? In particular, the website, the platform, the link to the platform. Take a look and see how it goes, right? Good. And the due date for the assignment, so we start very much the first day of April, and we complete this component on the 9th of May. So you have about 5 weeks, right? 5 weeks for everything, including trading and report. So you should have enough time, but for some reasons, right? You cannot make it by the due date. You need to let me know as soon as possible, okay? Especially if you have some commitment with other activities. Okay, Deakin has a very strict, procedures to deal with those things. If you submit late, there will be penalty. okay? And I'm supposed to tell you right now what is the faculty requirement, and I don't want to that to happen to you, but there will be checking. Sorry, there will be what we call collusion and plagiarism checking, okay? And there will be a team looking after that process. So make sure that you have produced relevant references and citations in your assignment, because otherwise there will be very severe penalties, right? So, and I don't want that to happen in this unit, okay? And late submission, now this is becoming very, very firm. I cannot do much about it. You got to let me know in advance, okay? At least 1 week, for example, before the due date, if you think that you cannot submit on time. Otherwise, this thing will apply. And the mark deduction, the penalty, is going to work with the maximum scores, okay? It's not the actual mark that you get, okay? So they take out, 5% per day, according to the maximum available mark in that component. So that is going to be a lot, am I right? Maximum of the report 25, am I right? So 2.5 marks. Sorry, 5% would mean 1.25 marks per day. Okay, it doesn't matter how much you end up with, am I right? They don't care about your performance. They just deduct marks based on the maximum allocated score. Okay, and if you submit 5 days late, the assignment may not be graded. Okay, that is the rule. Okay, any question before we move on? Fairly straightforward, right? Then the rest will be hardworking, right? And it will make it happen. So from my experience, once again, if you work hard in this unit, it's very likely you end up with a very high grade at the end, okay? High total score at the end. And if you don't work hard, it's very difficult to make it happen, okay? So set the objectives at the beginning, and then you can aim for, achieve your plan at the end of the term. All right. Let's move on to the main thing for today. Topic 1, internationalization of banking and finance. So this is very much an introduction to this unit. Am I right? So we go through the history a bit, and we discuss some main contents that will be explored in details in the subsequent weeks. Am I right? So today we have an overview. And I will also provide you with a refreshment concerning mathematical contents in this unit. So we have a recap of mathematics and economics as well, right? So the idea is that I want to show you upfront, okay, the level of mathematics required in this unit. So you know whether you need support, or it is too easy for you, or is that somewhat a little bit challenging, or it's okay, am I right? So depending on how we go, but I just want to show you upfront. If you are comfortable with what we do today, the rest of the term should be okay. Okay. So we're not going to go with advanced mathematical stuff like differential equations, for example. We're not going to do that. Okay. So equations is going to be linear. A plus 2 is 3. What is A? For example, right? Something like that. And if A goes up from 0.5 to 0.51, what is the percentage change? Right? So that level of difficulty only. Okay? Of course, I can do more advanced stuff, but I don't see the benefits. Am I right? So we stay with the basic formulas. Okay, so some motivations for the lecture. So I just want to introduce this story And there's a reference. If you look at the very last 2 lines on the lecture slides, you see the book by Nick Leeson himself. So he is a famous rock trader, right? A very, very famous one. He took down Barring banks, one of the biggest and oldest banks in the world. Okay, and just he himself, with some risky behavior, he took down the bank. Okay, he sent the bank to the court, right? Because the amount of losses based on his behavior was something like more than $1 billion. Okay, a lot of money, and so basically, Nick Leeson, right? He worked for Barings in London. Okay, he started with headquarters of Barings in London, and Barings is one of the oldest banks, investment banks in London. And he started as a regular employee, right? And he got promotion, whatever. And eventually, the bank sent him to Singapore because there wasn't some connection between Singapore and Tokyo at that time. In Tokyo, they did not allow certain activities in the financial market at that time, okay? But Singapore did. So Nick Leeson was sent to Singapore, to Cymex, to run a business for Barings from Singapore, okay? From Singapore. He was the manager and also a trader, okay? So a lot of financial products could be traded through Barings in Singapore, right? And among those, the popular ones were options, okay? Options trading, and that is very risky. You can also buy and sell, for example, government bonds, okay? You can trade indices through Barings. So they offer those services, right? So the expectation is what? They make money based on the commissions, right? Brokerage fees, that's it, right? And more trades, more fees, and that's how the bank can grow, correct? But Nick Leeson, he discovered a way to play with the market, okay? To have some fun, I believe, at the very beginning. So there was a so-called, so this is the time, right? 1992. So let me go quick. It's not our focus. So there was a hidden account with Barings, right? It's called file number 8. Okay, 8 is a lucky number in Asian countries, right? So file number 8. And that account, the objective, the purpose is to correct the mistakes by traders, right? And that was used in a very successful way by Nick. So at the beginning, he corrected the mistakes for his employees, right? For example, if you buy something and the guy, the trader, right, the dealer, he put as a sell order, it's going to be a disaster, correct? You are expected the next day you come back, where's my profit? There's nothing. You make a huge loss. Why? Because they made a mistake, okay? You ask them to put a buy order and they put in a sell order, okay? And that account can correct those things, okay? And Nick Leeson found out that he could actually use his account to trade, okay? To hide his performance, okay? Making money or losing money, he can use this account to play around. And the headquarters cannot find that out, okay? Because they don't care about the details, okay? They just look at the balance at the end. And the balance is only reported something like once a month, okay? So within the trading month, they don't care what you do, okay? So, and because of that, Nick started to like that activity, and he traded those financial assets for himself, okay, on behalf of the bank. And he made a lot of money, okay, in the first few years. He made a lot of money. He got a lot of awards. So if you're interested, just take a look at the book, right? He got a lot of awards from the bank because of the performance. But unfortunately, in 1994, he started to lose money, okay? And he was so scared because now, if you make money, that's fine, okay? Everybody's happy. But if you lose money, people will find out, okay? And they will ask you, what's happening? And he's a manager, he's in charge. So the loss was so big, okay? And Nick continued to try to recover it it's not time to make money anymore. Try to recover. And it did not happen. The loss became bigger and bigger. Okay? And in 1995, okay, in Jan, he decided that, okay, let's do a few more trades and stop it. Okay? It's too much now. Okay? Look, at the end of 1994, it was $200 million pounds. Okay? Big amount. So in 1995, Jan, okay, he decided to gamble very much, okay, open thousands of positions, right, in the option market, okay, and the activity was called short straddles. Many of you might have experienced this technique, right? So basically, you have positions working in both directions, am I right? So your expectation is that the market remains stable, so you can make a lot of money in the form of fees, am I right? In the form of fees. Buyers from both sides, they have to pay you the fees, am I right? But the way options work is that if the market goes either way, you're gonna be in big trouble because the loss will be unlimited. It might go forever, okay? Because it's not your long position, it's a short position, okay? The buyer is going to make money, not you, okay? You are selling. So all you get is the fees, am I right? Your expectation that the market would stay very, very stable, right? Would be very stable. It doesn't move. But if the market moves either way, you are in big trouble. So when we do options, right? Topic 5. I might get back to this if we have the time. And he lost a lot of money because of this event, the Kobe earthquake in Japan. The options were based on the Nikkei index, 225 index. And because of that earthquake, the Nikkei index went down in a massive amount, more than 1,000 points on that particular day. Okay, so one side of that short straddles did not work. Okay, one side sent Nick in big trouble. Okay, the other side generates some fees. That's fine, not enough. And then because of that, the loss were that big. Okay, it went skyrocket to almost 1 billion pounds. Okay, and Nick did at the very end, right before he decided to quit, right, to fly out of Singapore, get away, see around the world before going to jail. He knew it, right? It is obvious. So he decided to play with the Japanese government bonds as well. Okay, he was hoping some recovery, but it did not happen. And at the very end, the bank found out. And they had no choice but to declare bankruptcy, okay? And because of his behavior, at that time, more than $1 billion, almost 1 billion pounds, was very big, okay? Even nowadays, right? It is a massive number. It is crazy, am I right? So it is not what we do, am I right? So the reason why I'm showing this example is that eventually, even do forex trading, okay, you don't have that much amount of money in your account, only $50,000, but things like this can happen. Okay, you need to manage risk properly and make sure that you are not going to lose that amount. Okay, so at least you have a good balance at the very end. It doesn't have to be more than 50,000. It could be 40, it could be 30, whatever. Am I right? But don't show a balance $0. Okay. That is crazy because this is the same thing, and it is not good concerning risk management, am I right? Now there are other cases related to this, am I right? John Resnick from AID, Jeremy Curvier from Societe Generale in France, okay, and the last guy, the Japanese guy, Hamanaka from Sumitomo. So he was in charge of the bank's house for copper trading. Okay, so according to some sources, this Yasuo Hamanaka, he controlled the world market for copper. Okay, he himself, okay, with the funds from the bank, he controlled the market. If you want the price to go up, he can make that happen. If you want the price to go down, he can make that happen. He can adjust. Okay, because the bank's transaction volumes were very big. Now the second one, the middle, so the first one is a forex trader actually, okay. The second one is interesting, okay. Jerome Curvier. So there's a movie about what he did am I right? So very much similar to Nick Leeson, okay, risky positions, and he played with the management system, and he got away with the risk control department, okay. He got a friend from the risk control department, and he played the game. So the movie is called Team Spirit. Okay, if you're interested, it is available, I think, on the internet, maybe Netflix. If you are a customer, Team Spirit. You don't have to watch it, but in case you are interested in this kind of market, am I right? Take a look and see how it goes. So these guys, they live in a different world, I believe. Okay, they transact in millions, right? Just like we buy a coffee, right? And they make a lot of money. They lose a lot of money. But at the very end, okay, they are rogue trader because they play with the management system. They play with the risk control department. They get away from that, and in order to benefit from the market. So Team Spirit. Okay, if you're interested, take a look. So you will see the life of these guys in action, right? Huge money making, and then ending up with a very bad outcome. Okay. All right. Good. So that's good motivation. And again, the reason our objective here is just to let you know that it is a risky position, right? Trading forex, the same like other markets. It is a risky position, so you should manage the risk properly. Otherwise, it will end up with a very unfavorable outcome. So, why international banking and finance? So we have a lot of motivations for this subject, right? So, and traditionally, we have international trade as a starting point, correct? And then, because of international trade, with the world trade performance, the demand for payments, financial transactions grows as well, okay? And then that is the starting point for this subject. So globalization, right, has occurred in not just consumption. We're talking about trade, import, export, right? Cross-border transaction of goods and services, but also in production and investment. Okay, and that is massive, all right? Nowadays, big companies, they work at the global level, all right? The like of Samsung. If you think about a market for Samsung, it's very difficult to say because they sell their products in many, many countries, all right? In China, in the US, in other countries, all right? And if you look at the history of Samsung, I like Samsung for some reasons, right? So Samsung, it is one of the top companies in the world, correct? It is a dominant player in, for example, the mobile handset market, right? And many others. You see Samsung TVs, you see other things by Samsung, right? They are a big player. And in a few years back, they moved the entire mobile handset factory from China to Vietnam, okay? And just by the way, so I'm from Vietnam, right? So I like that company because now they are located in Vietnam, and they sell at least 50% of the mobile handsets from Vietnam, okay? And they set up a massive factory in Vietnam. It's not in the capital city. It is in a rural area. That is going to surprise many people, okay, in a rural area. And that is now one of the biggest factories by Samsung in the world, okay? They put in billions of dollars, am I right? Moving everything from China, moving everything related to the mobile handset production from China to Vietnam, okay? It's globalization, am I right? They're moving for a reason, right? China is growing, and now everything becomes expensive in China, but other countries, we are catching, right? The catching up process is going to give you some opportunities, right? And Samsung is smart in that direction, am I? They are saving a lot of cost at the moment by producing in a low-cost country. So firms, they also need to go international to maximize the shareholder wealth. Okay, if you are good in a particular activity, right? You don't want to go international. Your investors, your shareholders will ask you to go. Okay, because it has become a trend nowadays. You have to sell the product in a larger market. Okay, think about baby formula companies in Australia. Okay, and I have some research in that area as well, so that's why I want to use that example. So A2 milk, am I? Also like the Bellamy's, the organic products, am I? They are making a lot of money, am I? So traditionally, they sold their product in New Zealand and Australia, am I? And then the demand is growing quickly from other countries, am I? From China, from Vietnam, from other countries, right? People travel to Australia and they buy those products with them when they go back home and give them to their family, friends, whatever. And then they find a lot of benefits, am I? And a lot of issues, safety issues with similar products in China, as you all know, am I? And that is a chance for A2 milk and Bellamy's to make a lot of money, am I? They started exporting their product to China a few years back, and now they are making a lot of money. Okay, take a look at their financial reports. You will see what I mean. And they are growing, am I? They're growing very, very quickly. Now, A2 milk, for example, right? It is becoming, it grows every day. I can see their performance in the market. Okay, so they are getting better and better. And clearly, they cannot ignore China. Okay, starting from Australia and New Zealand, am I? But clearly they anticipate that China is the most important market. Okay, sooner or later they have to be there. They cannot ignore China. Am I right? So that is because of globalization. And the global financial system has been interconnected more than ever before. And nowadays we all see that happen, right? With a few clicks on the internet, you can transfer assets across countries. Am I? Before, it was not that easy. But nowadays, too easy. Am I? You can, if you don't want to invest in the Aussie market, you can send the funds to, for example, London, am I? And get a position there. You can even buy shares of companies in the US, no problem nowadays. Am I? Just click, a few clicks, and you can make that happen. So clearly, because of globalization, so everything has become a lot easier than they used to be, and that is opening up huge opportunities for this particular subject. Am I right? It is important, very, very important, as you can see, especially in topic 6, right? When we talk about risk management, if you ignore this market, okay, the whole thing will be gone. Even though you put in a lot of effort to produce a decent product, am I right? You have a good business plan. It is working for a few months, but then a chaotic period is coming if you don't manage the risk properly, just because of some changes in the financial market. Okay, your bank, your lenders, they might change their mind, and you will be in big trouble. Okay, especially mining projects in Australia, as you know, right? It's not easy for them. It's not easy for them to obtain funds for development activities. Am I right? Mining companies, mining projects. Am I right? And it is one of the things. Am I right? Now, it used to be the value of the Aussie dollar, for example, right? It used to be something like one on one to the US dollar. At that particular point in time, it is very difficult to convince lenders, international lenders, to put money in Australia because the Aussie dollar is too strong. Okay, but nowadays 0.7. Okay, it is a game changer. Correct? Some mining projects they re-emerge simply because the Aussie dollar has become weaker. Okay, before they could not convince international investors, international banks, right? But nowadays it is easier, okay? Still tough, but comparing to before, it has become easier, you know, right? Because the value of the Aussie dollar is 0.7. Well, I like to talk about the Aussie dollar very much because my experience in teaching this unit and talking with many people who have done research on the Aussie dollar, right? But I can tell you right now, eventually I want to do that in topic 2, but the idea is that Aussie dollar, okay? So according to many researchers, they believe the long run equilibrium, the value of the Aussie dollar should be about, how much? About 0.8, okay? That is the views by many people, many researchers, 0.8, the equilibrium level. 0.7 a bit low, but in the short term, well, it doesn't mean that it will jump to 0.8 overnight, am I right? But in the long run, in the next maybe 10, 15 years, you will see that if you put things together on a trend drawing, you will see that 0.8, it may not happen, but it's likely to be the case, okay? 0.7 a bit low, but it is a short run phenomenon, am I right? It might even go further down. Do you know why? Because of the potential rate cut in Australia, am I right? When RBA decided to go with another cut, the value of the Aussie dollar would fall, okay? And why so? We have topic 2 to talk about that. But clearly, in the short run, a lot of things will happen, am I right? A lot of things will happen. At the moment, the housing market is not in a good shape in Australia, you know, right? It is sinking everywhere. The economy is not performing. Comparing to a few months ago, if you look at the unemployment figures, right? The number is going up a bit, okay? So it is clearly not a good indicator for the economy, right? We want unemployment rate to go down, but it has gone down by a lot. But at the moment, it is going a little bit up, okay? And that is what policymakers don't like. So many people are predicting another rate cut in Australia in a few months, right? And that will change the value of the Aussie dollar, I'm very sure. Now, comparing between international finance and domestic finance, we can see obvious differences. The first one, foreign exchange and political risk. Okay, you are working with a different currency, am I right? You are working with a different country, right? You are trading in a different country. You are doing business with a different country or with partners from a different country. So clearly, the political risk is there, okay? You might invest in a developing country because the labor cost is low. They give you a lot of good policies, am I right? Come here, tax-free for 10 years, okay? You come, you put in a few $1 billion, and then they say, no, now we change the policy, okay? From tomorrow, the tax rate is 20%. What can you do, am I right? It is not in your hand, am I right? It is not in your hand. It is an international environment. You cannot control it. So clearly the risk is there. And even that is not the worst, am I right? The worst is that they will say something like, well, just run the business, make money. We welcome you to do that. But you have to stay here forever. You cannot go out of this country, okay? You make money, you reinvest, create jobs, that's fantastic. But if you want to take out your investment, we don't have a policy for that to happen, okay? You stay here, you get stuck, okay? It used to be the case in many countries, okay? Because of political reasons. So clearly, that is a risk that you have to think about, and that defaults in many countries, am I right? In Mexico, in Brazil, in Argentina, in Greece, Spain, am I right? Recently, a lot of cases. It is clearly out of control. And it is because of international positions, right? If you stay within the border of the domestic country, you don't have to worry about those things, right? And foreign exchange market, right? The foreign exchange risk, it is obvious because you are transacting in a different currency from the domestic currency, am I right? You have to play the game at that level because anything can happen, okay? Aussie dollar can be 0.7 today, but 0.8 tomorrow. okay, or 0.6, who knows, okay? No one knows. No one knows. It is, Aussie dollar is a very good example. It is a top 5 currency at the moment. It used to be top 6, but now top 5, I believe. And it is a free currency, correct? It is freely traded, and the policy governance here is good. So people, investors, traders, they like to trade the Aussie dollar, okay? But no one can predict exactly what happens tomorrow, okay? So if you talk to traders, right, they will tell you the best number I can predict for tomorrow is what we are seeing now, okay? Because the market has got everything in it, okay? All the expectations, all the predictions, all the forecasts, all the speculative activities, they have been incorporated in the market any single point in time. So the rate that we are seeing is the rate of today and tomorrow, okay? So if you ask them, what do you think about tomorrow? They will tell you, look at the number on the screen. That is the number that we will see tomorrow, because no one knows, right? It's impossible to know. If someone knows what would happen tomorrow, what's the point not to make money, right? They make millions easily. Market imperfections. So market imperfections, so what it means is that, well, think about, for example, the labor market, am I? Labor market is not perfect in the sense that workers, they cannot go from one country to another country to work, right? Follow the text, you can see that discussion more clearly. Workers, they follow certain locations, am I? You might see that in developing countries, workers are cheap, right? But you cannot bring them here to Australia, correct? It's very difficult, right? The law does not allow you to do that simple thing. Haircut service, for instance, right? If you go to a developing country, it doesn't cost much, right? Maybe $1-2, sometimes $2, okay? Especially if you go to Hanoi, it's very cheap, right? Whenever I go, I have a haircut, and before I come back here, I have another one because it's so cheap, right? $2, okay? Fantastic haircut, good service, you know. And here, $10 for a quick cut, okay? Sit there, you have 3 minutes, and they do it very quick. They don't care who you are, okay? They need to serve another customer after you. So clearly, big difference. But what can you do? You cannot bring the workers from other countries here, am I right? And ask them to do the haircut for you. It would be more expensive than, you know, $10. So because of that market imperfections, you should go international, and you deal with international conditions, right? That is different from domestic finance. Expanded opportunity set. Here you are talking about international business environment, and that is different from domestic environment because you see more opportunities. You see, for example, firms, right? Automakers, automobile companies, they set up factories in China. Am I right? They see opportunities in China, not just to export cars to other countries, right? Back home and to other countries, but also China itself is a good market. Am I right? So it used to be the case that China did not welcome that sort of investment, okay? They only allowed joint venture, okay? If you want to go to invest in automobile industry in China, you had to sign an agreement for a joint venture, for example. Okay, you share your knowledge, you share your expertise, you share your technologies, your know-hows, your patents with Chinese firms. Okay, you're not allowed to run everything by yourself, right? But nowadays, I believe that it is changing, and the same for other countries, right? Thailand and Vietnam as well. So clearly, opportunity is there. You have a question? Okay, so you go to a different country. And you have other opportunities to follow up the decision, and it is different from working within the boundary of the domestic country. Okay, and just a quick look at this chart. It is the performance of this particular exchange rate pair, Japanese yen, So two currencies, Japanese yen and US dollar. So the exchange rate is expressed this way, Japanese yen / US dollar. Okay, and we get back to this notation next week. Okay, but don't worry, it's just, it just represents an exchange rate, that's all. Okay, the exchange rate between the two currencies, it fluctuated, right? As you can see, if you take a look at the this line, the purple line, all right, you see that the number has been fluctuating, right, since a long time ago. And the same for other currency pairs, right? As long as the currency is free, right, it is traded in the market, you don't see a number. You see a lot of fluctuations, right, over time. Aussie dollar, very much same story, right? Huge fluctuations, up and down. It was even down to 0.47, I believe, in 2002. Okay, at the beginning of the mining boom, it was 0.27. It was at that time the economy was not performing very well. And then we had the mining boom, 2002, 2008, right? The Aussie dollar went up because the demand for Australian mining products, okay, went up in a quick manner. So the Aussie dollar, if you look at this period, right, it was going up, right? It was going up and then down, back down again because of the global financial crisis. Because the Aussie dollar is linked to the global commodity market in a very, very strong way. Okay? So, and the reason is obvious, right? We are exporting a lot of mining products from Australia. And if the demand for mining products goes up, the value of Aussie dollar will go up. Because in order to buy mining products from Australia, importers from other countries, they will need to buy the Aussie dollar before they do anything, am I right? And because of that, the value of the Aussie dollar will go up. Yes. Good. So, and of course, there are many other things, right? Not just mining products. Okay. The performance of the economy is also important. Correct? Because if the economy is sinking, no one wants to keep the Aussie dollar. Am I right? They just sell them. So the performance of the economy is also important. Unemployment rate, RBI's cash rate decisions, am I right? Housing market as well, right? If you don't allow investors from other countries to buy houses in Australia, the price will fall, am I right? Because the demand, domestic demand would be very limited, right? So why you have the housing price bubble in the last, well, not bubble, but the boom, right? Not bubble, but boom in the last few years, partly because of international money, correct? International investors, they put money in the market. That's why the price went up. If it is, at the moment it's not the same like that, right? The market is trending down because of many factors, but clearly one of the reasons is that international investors, they delay their plans, right? They see that the market is not performing, they wait, okay? They wait, and domestically, we have a lot of policy agendas on the table, right? The Royal Commission, the economy performance is not also that good, right? All of those things, they contribute to the performance of the housing market, and in turn, that impacts the value of the Aussie dollar. Sorry, I didn't have time to extend it to now, but I can do that next time maybe. Okay, and let's wrap up this before we take a quick break. All right, so why do firms go international? Why do firms invest overseas? So the first reason is because of trade barriers. Okay, if there's no barrier, if you can export for free from Australia to China, there's no point for you to invest in China, am I right? You stay here, it's safer, correct? You can protect the money, you can do anything you want, am I right? You don't have to go to a different country. But trade barriers, they are there always, am I right? A lot of barriers. That's why there's now an emerging industry in Australia, which is called the Daigou industry, am I right? People buying things from Australia and export by themselves directly to China, okay, and some other countries. They make money, okay, and the reason why they can do that is because the producers in Australia, okay, if they trade in large volume, they cannot do the same thing, okay? They cannot get away from the tax barrier, from the tariff barrier. But individual traders, individual shoppers, they know a way to play the game, am I right? They can make some money, small amount, but if they do a lot of transactions, the amount is quite significant, am I right? The size of the Daigou market at the moment, according to some reports, is more than $1 billion, okay? More than $1 billion. So A2 milk, Bellamy's, right? Black moss, for example, they also make money, right, from the Daigou market, but they cannot do the same thing, right? Daigou people, they have a chance to do those transactions and make money, but big companies, they cannot do that. They have to go through the official channel. The tariff rate is high, even though at the moment we have the free trade agreement between Australia and China, okay? It has been signed and it is in effect now, but still, okay, the tariff barrier is there, but comparing to Daigou traders, right, you cannot play the same game because they know the best way to export the product directly to their friends, okay, to the customers, but you cannot do that. So trade barriers, very important, that's why you need to go international. And just further information, right, if you think about 1980s, right, you think about tariff rate, right, let's focus on the official channel, export channel. In the 1980s, the average tariff rate in the world, comparing to nowadays, it goes a lot higher, okay, it goes a lot higher. So you're talking about more than 20%, okay, more than 20% on average. Nowadays, how much? It's not 0%, right, not 0%, around 5%, okay, around 5%. So 20% versus 5%, you see a big difference, correct? That is a huge difference. Okay, so let's take a short break before we move on. So the next important reason why firms go international is called intangible assets, okay? So imperfect labor market, I already explained with the example of investment by firms in a developing country, right? So the labor market is not perfect. Because of that, firms go international so that they can take advantage of the conditions where they invest, right? That might be cheaper comparing to the domestic country, especially the case when you go to transitional economies, right? Everything is cheap, especially the labor cost. It is very low, and your business can improve comparing to the case when you locate at home because the labor cost is high. Now the next one is intangible assets. So intangible assets, they are something unique, okay? You have access to those assets, but competitors don't, right? And it is related to what we call OLI theory, right? If you go to this area, to the international investment area, you might come across this term, OLI theory, okay? And it is proposed by John Dunnings. So the idea is that you go international because you have ownership advantage, right? You own something that your competitors don't. Coca-Cola, for example, right? They have some trade secrets that you don't, right? You cannot make the same amount of money because they have something they know, you don't, okay? They have access to certain technologies, right, to produce the Coke, and they can sell them all over the world, okay? They can invest in Australia, they can invest in China, they can invest in Vietnam, am I right? And they sell things in the in the local markets, right? They produce a Coke and they sell them in the local market, right? Clearly, in order for the company to do those things, they need to own something specific, okay? And that is the first element here. It is ownership, advantage. That is what the O stands for, okay? The L is locational, okay? Or location advantage. And the I is internalization. Okay, so this is international theory. So OLI. As long as you have those advantages, you go international. If you don't, there's no point for you to go. Okay? If you're not better than your competitors in those locations, right? You cannot survive. Correct? You need to own something specific. You need to know about the place where you are going to locate. You need to be good in what we call internalization. Okay? What it means is that you internalize everything. Right? Apple, for example, right? It is another good example. It is one of the largest companies in the world. Apple. So they have components, right? So the iPhone, for example, right? If you look at some research reports, you see that the components, they are coming from all over the world, from many countries, okay? You see some components coming from Germany, from Japan, from Taiwan, okay? From the US, of course. But if you look at the back of the iPhones, okay, it's not made in, but it's assembled in China. What does that mean? China contributes something to the iPhones, okay? But if you look carefully, if you break down the components, the contribution from China is mainly in the form of the labor cost, nothing else, okay? Labor cost. And that's not much, right? That's not much. So a few dollars, okay? A few dollars. So I'm talking about the previous model of iPhone, which I have the report on, the detailed report. The current version, I'm not 100% sure, but I don't think a lot of differences, okay? So the contribution from China will be, I believe, still in the form of labor cost to the iPhones, okay? But why in China? Why everything in China? Why does Apple send everything to China and then get the iPhone from China? Cheap labor, am I right? And that is also a place where they can internalize everything, okay? So one way to internalize everything is that you don't want to outsource your thing to a third party, okay? You want to do everything by yourself. You don't want, other people to do it for you.
But it's not only cheap, it's professionals.
Second?
They have professionals.
Yes, of course, yes.
It's not only cheap labor.
Yeah, labor is just one of the things, not everything, okay? So the skills are also good, okay? They are improving, and it's a trend everywhere in developing countries. They have to do that, okay? They cannot attract investment, foreign direct investment, without a proper preparations, okay? If you go to developing countries, you see they even have universities, all right, specific to a particular project, right? To a particular project. So clearly, local policies, they are important. But labor cost is important. Internalization, it is one way for you to control the entire process. Okay, you don't want to outsource some of the components to the third party. Okay, you want to control it, and there are obvious benefits. All right, the obvious benefits. You don't want to lose some of the trade secrets to your competitors. So that three advantages, they are important concerning the decision of a firm to go international. Okay. Now, the next one is called vertical integration. Okay. So what it means is, again, it's related to the last point, right? It is the idea where you have things in the same place, right? You put things together in the same place, right? You integrate everything in the production process, right? You don't want to do one thing in country A and another thing in country B, right? You go to a particular place so that you can bring everything together, okay? So that is different from what we call horizontal business strategy, okay? You do the same thing everywhere. So vertical strategy is more or less, you are talking about the concentration of the production process, okay, in one place, right? So more broadly, we have the term vertical FDI, foreign direct investment, and horizontal FDI, okay? So vertical, it means you go to one location with everything, okay? And you might want to sell the product all over the world, okay, from one factory. Now, horizontal FDI is different, right? You might want to invest in country A, to serve country A's market, and then you do the same for country B, okay? You have another factory in country B to serve country B's market, okay? It's called the horizontal FDI, okay? Different. So, if I have the time, I can talk a little bit about this, but it's quite interesting, right? So vertical versus horizontal, right? If you go to supermarket, for example, right? When I present my research papers, I often use that example. You go to supermarkets, right? If you like a particular brand of ice cream, okay, all that matters to you would be which flavor, okay? Suppose you have to stick to a particular brand, right? And then you decide which flavor to buy. That's all, okay? But if you think outside the box, that is an example for horizontal, okay? You have similar products, same price tag, just different flavors, right? Now the vertical example is where you think about you have certain amount of money, right? You want to go up high or you want to go down there, okay? So what quality do you want to buy, okay? You can pay $10 for the same Chulito box of ice cream, or just for $4, am I? So it depends on the quality. Okay, so product life cycle, right? It is related to the Vernon theory, Vernon 1966, I believe, okay, the famous product life cycle theory, okay, that earned him a lot of citations, more than a few thousand citations, I believe, or more than 10,000, I don't remember exactly, but thousands of citations on his work. While the related one, if you want another term, is called the flying geese model, okay? Flying geese. It's similar to the idea of product life cycle theory, and they were published very much the same, not same time, but same decade, okay, 1960s. And the second one, the one that you see on the screen, so let me remove this one. So the flying geese model, so they were developed by the Japanese, right? So it is developed by the Japanese. So what they argue is that countries, they follow the pattern of the geese, okay? The leading goose would be Japan. Well, the theory is coming from Japan, okay? It is the leading. And then you have followers, the like of Korea, Taiwan, Singapore, okay? They follow the leader, the goose, okay? They form the pattern. And then after that, you have the whole bunch of newly industrialized countries, right? Thailand, Indonesia, Malaysia, Vietnam, Cambodia, and so on. Okay, all together, you form a group, and it's like a flying geese, right? That pattern, so that kind of idea. And the idea is similar here, right? So product life cycle theory. So that is the US version, right? So if you have a new technology, right, it works very well at the very beginning, but after a few years, the technology becomes mature, correct? It is time to move on. You develop a new product, a new technology. But the old technology is still there. It is matured. It is not useful for you, but it might be very useful for followers, okay? For other countries, because they don't have the same technology. They still like it. They are happy to pay a lot of money for it. So why don't you just sell that to them? That kind of idea, okay? If you introduce that old technologies to other countries, and you can still make some money, okay? You don't have to just ignore it. So that kind of idea. Okay, and finally, shareholder diversification services. Okay, that is becoming obvious nowadays. Okay, you have to do things at the global scale. You cannot stick to the domestic market because even if you don't go, your shareholders will ask you to go. Okay, they want to do that. And for example, if you think about a bank, right, and you have a big customer, they go international. They go international. They go to South Africa with the mining project. You might need to follow them. Okay, otherwise they will end the agreement, the contract. They source their finance from a different party. Okay, so if you offer a good service in Australia and your customer goes international, you might need to follow them. Okay, you need to do that. So going international has become a trend, and we also have some statistics coming out of the UNCTAD, right, the United Nations Conference on Trade and Development. Okay, they have annual reports on activities of foreign companies, of multinational companies. Okay, if you're interested. So in 2010, the world had almost 1 million foreign affiliates of those 100,000 MNCs, okay, multinational companies. Right, the number is huge. A lot of foreign branches for these companies, and most of those foreign affiliates, they were located in Asia. So this is coming out of 2010 report, right? Nowadays the number might change, but the trend should be the same. And the number of greenfield FDI projects in 2011, more than 15,000. More than 15,000 projects. Greenfields, it means what? Pure FDI, okay? Not joint venture, just pure FDI. FDI, that is new, and that's for genuine domestic production, okay? New project. And cross-border merger and acquisition in 2011, more than $500 billion, okay? And the number is the last number is also interesting, okay? Up and down, okay, following the crisis. But at the moment, I think it is, so after this period, it was falling a bit, but now up again, from the last time I checked. Now, FDI, right? If you look at the locations of FDI, then obviously China is attracting a lot of FDI, but that is when you think about developing world, right? But at the global scale, the US still a big player. Okay, they attract a lot of investment from foreign investors. China is growing, and other countries. You have France, Germany, right? Still a lot of developed countries. So when we talk about international production, right, we tend to think about China, Vietnam, Indonesia, whatever, am I right? But if you look at the sums, so actually developed countries, they attract most of the investment in the world. Okay, not developing countries. Okay, not developing countries. So you see, so one way to think about this issue is to look at the values of the investment, not just the product, right? From China, from developing countries, you see the actual low value products, okay, very much. But in those countries, huge, they make bigger things, okay? Airplanes, for example, right? Huge amount of money. So you cannot compare small products, paper, bottles, and even computers with those large projects. So that's why US and some European countries, they still attract a lot of investment. Okay, so let's go through the history quickly, and we can go to the mathematical notes. Like I said, quite quickly, because we will come back to these points throughout the trimester, okay? Especially in topic 4 and topic 7. We'll go through the details. Now, the focus of this unit, we are not going to go too far backward, okay? So the focus will be from the World War II up to now, okay? Before World War II, all that you need to know for the purpose of this unit is the gold standard, okay, before World War II. And after that, we have the whole bunch of things, right? From the World War II, we have the Bretton Woods system and the current system, okay? A lot of things that we need to talk about. But before World War II, all you need to know is the gold standard, starting in the about 16th, 17th century, okay? And don't worry, because in topic 4, we get back to that in detail. Now, before World War II, in the online document, right? If you take a look, you see a rich history, right? From back to thousands of years ago, right? You see who was the dominant player at that point in time. And if you follow the document, you see that the Italian, okay, they were very, very important player in the global financial market at that time, okay, about 1,000 years back. And then because of the historical reasons, right, we have the like of the Portugal, who else? The German as well, right? The German, the Dutch, I believe. And after that, we have the British, right? And that is the beginning of the gold standard. So before the 17th century, right, a lot of other countries, mainly European countries, they play a role in the system. They created methods, right, and regulations, not formally, very much informally, right? But that is a good starting point, right? If you don't have those starting points, you don't have international banks nowadays, okay? The Italian, for example, they invented the double entry bookkeeping system, right? And that is being used everywhere nowadays, at the firm level, at the country level, right? So it is invented by the Italian. Okay, and the UK emerged in the late 17th century because of political reason as well. And on top of that, we have the Industrial Revolution, right? And that makes UK a big country, okay? That is a big country. And they formed banks and things like that, okay? They created system, and they even produced some relevant policies to govern the system, okay? That was lacking in the previous system, okay? The Italian, the Dutch, the Portugal, for example, very much family kind of system, okay? Some big family, powerful families, they rule. But the British, they changed the entire thing. And with the government participation, things became more stable, okay? The system remained for a long time, okay? The gold standard system. And in topic 4, when we talk about topic 4, I will go back to the gold standard system. We talk about the details, how it works. And still nowadays, right, many researchers, especially macroeconomists, they still want to go back to that system, okay? The gold standard system. It is fantastic. Gold is number 1 currency if you want, okay? Every currency is pegged to gold. And the system was very, very stable. No chaotic events, okay? You don't have financial crisis and things like that, because nothing is fluctuating, okay? All the currency are fixed. You don't have option contracts, okay? You don't have derivatives, nothing, okay? You even cannot trade currencies because there's nothing to trade, okay? The exchange rate is fixed and it's stable. Every government in the world is working hard to protect those currencies, right? So everything is fantastic. And it was a very good period in global finance. And still people want to go back to that at the moment, after all, but it's not easy, correct? It is very difficult. Gold, they are not a store of value, right? Comparing to some strong currencies nowadays. So it's very difficult for people to convince countries to go back to the gold standard, okay? Gold is used for different purposes nowadays, mainly speculative activities, I believe. Now, from late 19th century up to now, we have the US, okay, to emerge and become and remain so as the most important player, okay? And mainly because of the World War II outcomes, But nevertheless, they are a strong country and they have a good system of governance, and that is going to be good. They can convince the world to adopt the so-called Bretton Woods system. Okay, without a strong country, without a powerful country, you cannot convince other countries to follow. Okay, this system is also good, but it did not last that long. So the Bretton Woods system, right? It is the system started after the World War II. Okay, so countries, about more than 40 countries, they met in Bretton Woods in the U.S., a town in the U.S., and they decided to form the new system. Okay, to form the new system, and of course within that system, the U.S. is number one economy. Okay, is the most important country in terms of how the system works, and the formation of these three bodies, important bodies, right? The IMF, International Monetary Fund, the World Bank, and the General Agreement on Trade and Tariffs, right? Which is at the moment the WTO. Okay, the formation of these three important organizations of the global scale was back to the year 1944. And within this system, the US dollar was number one currency. Okay, so the US dollar was fixed to gold. Now remember the gold standard within this period, the before World War II, right? All currencies were fixed to gold. But within the new system, the Bretton Woods system, only the US dollar is fixed to gold. Now when a particular currency is fixed to gold, the government has to be very active to protect the value of the currency, am I right? So the US government has to make that commitment, okay? They declared the commitment to maintain this exchange rate, right? $35 an ounce of gold. And that is protected by the US government. So the idea is that you can buy and sell unlimited amount of gold. You can trade unlimited amount of gold with the US government. Okay, they make it happen. They have a huge gold reserve. Okay, if you want to buy, they can sell it to you. If you want to sell, they can buy that from you. And the exchange rate is fixed, no matter what. Okay, that is the international commitment. They have to maintain that for the system to work. And as you can see, in 1971, the system collapsed. Simply because the US walked away from the commitment. Okay, they say, look, the US economy is not in a good shape. By the way, so in topic 4, I get back to the story. Okay, I explain why in very detail. Today it's just a big picture. So in 1971, the US president decided to give up this idea. Okay, they said. So he declared the no commitment to the system. So the exchange rate between the US dollar and gold was allowed to fluctuate. Okay, that was the end of the system because the US said that in the market at the moment, the gold price is 41, 42, 45. Why do I have to keep it at 35? Am I? We are not in a position to make that commitment. Okay, at our loss. Okay, let it fly. Okay, that is the idea. And the main reason was because of the U.S. troubles, right? During this period, right? They involved in the Vietnam War. The current account deficit was huge current account deficit. They had to spend a lot on military activities. And also they had the budget deficit. And the reason for the budget deficit is also nice. According to the so-called chiffon dilemma you see in topic 4, if you have this kind of arrangement, okay, sooner or later, the disaster will come. You cannot have one country to fix their currency to gold, and all other countries just free ride on the system. Do you know why? Because they know that gold is limited, am I right? You cannot dig gold every day, am I right? The amount of gold, underneath the earth, it is limited. But the economy keeps growing, correct? US is growing 2% per year. Japan maybe at that time maybe 5% because of the automobile industry. Maybe 5%, China 5%. Everybody is getting richer and richer. and the amount of bond is limited. The US is in trouble because they cannot print a lot of money. They have to print certain amount of dollars just to support the amount of bond in the world. That is their commitment. And by doing that, they cannot grow. Okay? So you cannot ask US to be in trouble and everybody is happy. You cannot do that. If you sell something, export something to the US, you get the US dollars. You don't want to spend it because US dollar is so powerful. Am I? You want to keep it. You don't want to return it to the US. Okay? So they run out of money. The US will run out of money. They have budget deficit. Okay? And together with the current account deficit, they ended up with a big trouble and they had no choice but to walk away from that commitment. Now, since 1973, that's also why if you look at the chart I show you on some currencies, right? You see that the time period is from around 1970s, not before that, because before that, if I want to draw draw the chart, it's just a straight line, okay, horizontal, flat line. The exchange rate was fixed before 1973. Now, since 1973, many countries they decided to adopt the so-called flexible exchange rate regime. So the idea is that the Aussie dollar at the time, the Australian pound, right, should be allowed to fluctuate. Okay, so there's no point to fix it to something. Okay, it is a free economy, so the currency should fluctuate. If the economy gets stronger, the currency will be stronger, and so on. Okay, and many countries they decided to adopt that new regime, right? Japan, European countries, many. Nevertheless, what I can tell you is that according to the latest documents from the IMF, the number of countries that follow the fixed system still outweigh the number of countries that follow the flexible system. So now the idea is that nowadays, if you look at the currencies around the world, okay, many of them are still fixed to either US dollar, the euro, or a basket of currencies. In many cases, a basket of currencies. They are fixed to those currencies. Okay. You see a lot of currencies fluctuating, but not that many. If you think about the entire world, okay, many currencies are still fixed. And some countries are in between. Okay, they say that okay, we have a flexible exchange rate system, which is managed by the central bank. Okay, very contradiction, right? It is a flexible system. It is a floating system, but it is managed by the central bank. So a little bit confusion. The idea is that okay, we allow the currency to fluctuate, but if it is fluctuating too much, the government will step in, okay, because it's not good for the economy, right? So we want some fluctuations, but we want the trend to be stable, okay, over time. It should be stable. Too much fluctuations is not good. You know why? It's hard for business firms, okay, to plan ahead. If the exchange rate is like this, right? How can you if you think about mining projects in Australia, again, it's very difficult to convince lenders, okay? If you don't have a good projection for the value of the AUD, they don't know how much to invest, okay, to lend to you, because they lend in US dollars, correct? International currencies, and job performance is based on AUD, okay? How do you convince them that the business is a good one, okay? What if the AUD goes up to parity again, okay, one-on-one against US dollars? The lenders will be in trouble, right? Not just because you cannot make money to return to them, but also that they lend to you in US dollars, and now the value of the package has become a lot smaller, okay? All right. Another milestone is the oil crisis in the 1970s and also in the mid-2000s. So in the 1970s, early 1970s in particular, the price of oil in the world jumped from how much? Around $3 to $12 a barrel. Okay, from $3 to $12 a barrel. That is a lot, you know? That is huge. Well, if you think about the $9 change, you say that it's nothing, okay? But if you think about the percentage change, It is 400%. Okay, 400%. That's huge. Not to say end of the 1970s. You have another jump, 100%, another 100% at the end of the decade. Okay, so that's huge. At the moment, how much? We are looking at around 60, 65, right? That mark for a barrel of oil. And at that period, only $3 and $12. Okay, it's nothing. But if you think about the relative change, it's huge. Huh? From 3 to 12. It's the same like if you go tomorrow, you go to the petrol stations, you see the price to be 500 instead of 120. Okay, it will change your mind. What's going on? Okay, so expensive to drive a car, am I right? 500 is crazy, am I right? But something like that happened in 1973, and it's more important because oil. No wonder it is important input of production. Okay, you see oil as an important input of production in almost every industry. Okay, oil is very, very important. You need oil, and because of that, the oil price crisis impacted the global economy in a very significant way, and that also was the main reason for the so-called Latin America debt crisis. Okay, in the 1980s. Some countries, they made huge amount of monies, right? Because of the oil crisis. If you export oil, fantastic news, right? The price is going up from 3 to 12. Come on, fantastic time, correct? You make huge amount of money, a lot of money, and then you don't keep them at home. You lend them somewhere else, am I right? You lend them to Mexico because they have good automobile plants, okay? Because they are producing something that can export to the world. So you can make your money grow. Now Mexico, unfortunately, falls into trouble, and your money is gone. Okay, that is the crisis in the early 1980s. Okay, the debt crisis. Mexico, Brazil. Okay, in particular. Okay, and in the mid 2000s, we had another oil price crisis, but not much. Okay, it was at that time. I remember. It was hitting something like, if you go to the petrol station, it was, I think, around 190, okay? 190 cents a liter of unleaded petroleum, okay? 190. It was a big number at that time. But that crisis was okay, right? Comparing to the 70s, it's huge. And many countries suffer from the so-called stagflation because of the oil price crisis. They cannot get away from the crisis. So this is what we call the long run, the aggregate demand, aggregate supply model. Am I right? Okay, so, and it's coming out from the MP781 unit. Alright, so stagflation is when you have a shock on the supply side. Okay, the shock on the supply side. And in this case, because of the oil price crisis, but theoretically, it might come from the policymakers as well. Okay, for example, if you have a sudden change in monetary policy, okay, if you print too much money in the short run, it might have similar story. But here, the oil price crisis is easier to understand, right? When you have oil, important input to be so expensive, firms, they cut down their production, right? So SAS is very much short-run supply curve, okay? Short-run aggregate supply. It is shifting to the left, okay? So the idea is that firms, they don't want to produce anymore. They cut down the production, they fire workers, right? And output will fall. GDP will fall. Now GDP is falling, but at the same time, you have high inflation, okay? So that is what we call what? Two bad things going on at the same time, right? So double whammy, okay? Two things at the same time. High inflation and low growth. And very difficult to get away from this situation. You have to sacrifice something, right? You might want to kick in a policy to control inflation. For example, the US, okay, in the 1970s, right? What they did, they increased the interest rate, okay? And still a lot of debate whether it's a good policy or not, we don't know, right? But But nevertheless, if you look at the performance of the US after this period, right? When you increase the interest rate, the inflation rate will go down, okay? That is one way to control inflation. And the problem is, if you increase the interest rate, firms could be in trouble, right? They don't want to borrow money. They are already in trouble, and now you give them more troubles, okay? The economy will fall into recession. But like I said, this is a hard situation, am I right? You cannot rescue the economy without sacrificing something, okay? So you have to accept the fact that in the case of the US, right, grows. The trade grows for inflation at that period. Another possible policy would be what? You can do the opposite, okay? Increase money supply, just to get the economy back on track. Accepting the fact that the inflation rate will skyrocket, that's fine, okay? And then after that, you control inflation. But clearly you have to do something, okay? If you don't do something, according to Keynes, right, the process will continue. Firms will continue to cut down production. Output will go further down to zero, okay? So clearly, a policy is needed. Okay, so next thing, in the history, the rise of the European Union and the Euro, right? We all know that they started in the 1950s with 6 members, right, at the beginning, and they expanded to, I believe, almost 30, right, 28 members nowadays. The Euro was introduced in 1999 in official transactions only, and it started as a currency in the financial market in 2002. Okay, people started to trade currencies, to trade the euro in 2002, and it has remained until nowadays as one of the most important currencies. Right? It cannot overtake the US dollar, but still, I believe number 2. Right? It was the Japanese yen before, right? That was more important. But the euro, given the size of the European economy, it is growing. The emergence of the euro currency market in the 1950s. So in topic 7, we get back to this market. Right? It is a unique market. It's not about the euro, okay? It is just about foreign currencies, right? So the idea is that these are the definition is the last dot point, right? If you look at the last dot point on the screen, the euro currency market is a market for assets and liabilities denominated in the currency of a different country, okay? So if you talk about transactions in Japanese yen in Australia, for example, right? If you are a company and you want to raise funds in Japanese yen in Australia, right? Well, I'm not saying that you can by law, but suppose you do that, right? Then that Japanese yen is actually called an euro currency, okay? Because it's a foreign currency to Australia. Japanese yen has nothing to do with Australia, okay? And you are transacting in Japanese yen. You are trading euro currency, right? And precisely in that case, we are talking about euro Japanese yen, okay? Euro Japanese yen. So euro just means foreign, okay, in this context, and it has a history, right? If you follow the text, the reason it was because of, the political tension during that period, right? There was two parts, right? The Cold War period. Some countries exported things all over the world, and they earn income in US dollars. Now the problem is, the US dollar was not safe to be kept in other countries, okay? Because of political reason. You cannot, and some countries they don't want to keep, for example, the Soviet Union, right? They don't want to keep the US dollars in the US. It's too risky, am I? They might just squeeze them out and they don't allow the withdrawal, right? Then you are in big trouble. And because of that, they deposited those amounts in Europe. Okay, in European countries, they are somewhat like a friend of everybody, okay? They stand in between the two sides, and that was safe for money to stay in those European countries. That's why the term euro currency appeared during this period. Okay, it has nothing to do with the euro, by the way. And in the since 1980s, we have capital mobility, deregulations all over the world. Okay, the rise of globalization, as I mentioned before, the removal of capital controls in European countries, and also Asia. Okay, so not too much, not too strict control, and that is a chance for business firms to invest, right? Because if you have too tight control, they don't want to invest. They don't want to put money in a big project where the government controls everything. Okay, so if you remove those controls, capital will come, money will come. Okay, and European countries, when they joined the European Union, right? They had to play the common game. Okay, they have to follow the same procedures and same policy agendas, right? They have certain limits applied to, for example, budget deficit, right? The case of Spain and Greece, 2009, correct? They had some way to play with the numbers, okay? But the actual debt was above the limit, okay? The limit within the European Union was a lot lower, okay? Certain amount of deficit can be allowed, but not 12%, for example, right? The deficit in those countries were more than 10%, okay? More than 10%, and it's not allowed. It is over the limit by a huge amount, okay? And when some countries in the European Union, right, they remove the control of capital, they become a free economy, right? Enjoy high growth, stable, income, and economic environment, right? So it is a good example for other countries. And in Asia, we have the same trend. We call them privatization in the case of Asia, right? So it has a reason, right? In Asian countries, mainly during this period, right, 1960s, 1970s, the government, they control a lot of things, right? Even business community, they have state-owned enterprises, okay, to dominate the economy. So private firms, in some cases, they are not allowed to operate, okay? So if you're telling people you're a private firm, you want to make profit, you might be in big trouble in some countries, okay, during this period. So the government controlled everything, but then they did not grow as fast as they expected. So privatization became a trend, right? In China, in Vietnam, for example, right? Nowadays, if you don't have privatization, if you don't support this, you are in big trouble. Before, you're not allowed to talk about it, but now, if you don't support it, you're in big trouble. Okay, that is the trend. The government likes it, they want to promote it. Okay, you have to support it. As a policymaker, that is unavoidable trend because that's the only way for the economy to grow. Am I? You don't own everything, okay? You have to think about the most profitable way to do business, okay? And because of those changes in the policy frameworks, we know that asset prices have become very, very volatile, okay? And then we have a set of new financial instruments that we can observe in the world that did not occur before the 1980s, okay? The like of options, right? Call options, put options, right? Currency derivatives, foreign exchange derivatives, and so on. Okay? They are new products, right? In the world, new financial products. And recently, we have what? Bitcoin, right? Bitcoin, exactly. Is that currency or not? I don't know. Many people say yes. Many still say no. Does it have a future? Many say yes, many say no. Okay? And is that an asset class? Many say yes, many say no. Still in debate. Okay? But it is already there. Okay? You can trade Bitcoin even within our platform. But I already work with, so the idea is that we don't want students to expose to Bitcoin. Okay? Sometimes the system might not allow you to do that because it's a new product. They are still testing and implementing some changes to allow the Bitcoin transactions. But please do not trade Bitcoin for the purpose of assignment. It's a new thing, right? And we don't have government to support the Bitcoin. I mean, to stand behind the Bitcoin in the sense that there's no Bitcoin supply policy, right? There's no interest rate policy and that sort of thing. Okay, it's very difficult to explain, to justify the position. This is purely speculative activities. Correct? You buy and sell Bitcoins. It's hard to explain. Okay, very difficult to explain using economic fundamentals. There's nothing for you to explain. Okay, good. So the last thing for the history of international banking and finance that we want to talk about would be the formation of these global bodies. Right? The World Trade Organization is important because it is changing everything. Like I said, right? 30, 40 years ago, tariff rate was 20% on average, more than 20%. Nowadays, 5% and going down. Okay, 5% and going down. So clearly, it is because many of WTO, right? They have the so-called most favored nation treatment. Okay, so the idea is simple. If you join WTO, right? If you join WTO, and if me and him, right, we are also WTO members, right? If you join WTO, we are on the same table. Okay, whatever I'm giving him 6% tariff rate. I have to give you the same. Okay, because that is a WTO rule. Okay, that is the most favored nation rule. So by following that rule, the tariff rate will go down quickly. Right? You cannot, you and him, right? You can trade, you can do 10% with each other. But once you join WTO, it's not the case. Okay, because I and him, right, we do 6%. Eventually, you need to get to 6% as well. Okay. European Union, ASEAN is also a good example, right? So they are very dynamic, young nations, and they are growing very, very quickly. They have also the so-called CEPT, which is the common, which is a tariff arrangement within the group. Okay, so if you invest in one of the members of ASEAN and export your product to a different country, which is also within ASEAN, they give you a special tariff rate. Okay, you don't have to worry about 20%. It could be 0%. Okay, so the objective of ASEAN is to drive the tariff rates down to 0%. So they give preferential tariff rates for the members. Okay, so clearly it's a very good way to expand the business. And financial crisis and its contagion. So Latin America debt crisis in the 1980s, like I said, one of the reasons was the oil crisis, the oil price crisis. Okay, some countries, right, in the Middle East, they earn a lot of money and they invest in other countries, including Mexico and Brazil, and they could not get the return simply because the governments of those countries, they decided to go for a debt default. They say, we cannot service the debt anymore. Okay, it's too much now. We borrow from you too much, but sorry, I cannot return the money. Whatever you want to do, I can't do anything. I'm sorry. That's it. They walk away from the commitment. Okay, and then we had IMF to step in, the World Bank to step in, but well, it's not the end of the story, right? Because of the follow-ups. It takes years for you to recover, right? Walking away from the debt is easy to do, okay, because they cannot hurt you immediately. But over time, what's going to happen once you do that? Other lenders, they don't give you money, okay, because they observe what you did to that friend, okay. They won't give you money. It will be in big trouble, okay. No jobs, high unemployment, high inflation, okay. That will last for many, many years, okay. So walking away from that is easy thing to do, but the outcome will be massive on the economy, okay. Asian financial crisis in the 1990s, okay, late 1990s, and US subprime mortgage crisis in the late 2000s, right, 2007, 2008. Financial crisis in Asia, 1997, 1998. So there's a link up there. to a lecture by Joseph Stiglitz, a deacon. Okay, he's a famous name, as many of you know. He's a Nobel Prize winner in 2001. Okay, he won a Nobel Prize for his works in market economies. And I had a chance to talk to him on many occasions. Okay, from my work experience. Immediately after he got the Nobel Prize, he came to, he was with the World Bank at the time, okay, the chief economist and vice president of the World Bank. He traveled around the world, especially developing countries, to give policy advice, okay? And he was talking a lot about the financial crisis in Asia at that time. And I was a journalist in Hanoi at the time, and I had a chance to talk to him in person. And then recently, when he came to Deakin, another chance, and both of the talk were about crisis for some reason, just bad luck, right? Bad timing for the global financial market. The first one was just after the Asian financial crisis. Second one was after the US crisis. Okay, and we talked about the same thing. He gave me a book previously about the financial crisis, a thick one. Okay, I still keep it. Okay, so if you're interested, hit this link to learn about US subprime mortgage crisis and to some degrees the European debt crisis. Okay, not the same but related. Okay, the idea was similar. Greece, for example, right? Housing price bubble. US housing price bubble. Okay, that was the cause of the crisis. And in topic 7, we go through those details. Don't worry, we have a story for that. But the link, Stiglitz was talking about an interesting idea, which you might want to know and might be relevant to Australia at the moment. The idea is that those companies, those banks, okay, some players, they were too big to fail. Okay, they were not allowed to fail. They were just too big. They are biggest players in the market, and the government did not allow them to collapse. That is a problem. Okay, the government had to support their behavior even though it was wrong. Okay, and then he also mentioned that it was too big to jail. Okay, you cannot send those corporates heads to jail. Okay, because of their wrongdoings. Okay, the government supported them, and that was their mistake to some degrees. Okay, his talk was a little bit technical, but I am sure you still understand the basic message. Okay, he tried to walk away from technical details, and he tried to deliver some nice message. So hit the link, and I'm sure that it's still there, but if not, let me know. Okay, so in this unit, it is a summary of very much what we will be doing during the trimester, am I? And we will break the details into 7 topics. So today we've done with topic 1. Next week we will move on to topic 2. Okay, we'll be talking about the foreign exchange markets and the balance of payments. Right? We talk about both the market and also the policy agenda. International parity conditions, topic 3. Topic 4, international monetary system, exchange rate arrangements, and government intervention. Topic 5, foreign exchange derivatives. Topic 6, foreign exchange exposure and management. And finally, topic 7, international banking and global financial markets, debt and financial crisis. Okay, that is the 7 topics that we'll be talking about. And among these topics, the most important one is topic 2. Okay, because topic 2 has got a lot of content in it, but more importantly, it provides the foundation, okay? All the definitions, the frameworks, measurements and simple calculations, they're coming out of topic 2. So because of that reason, we will spend about 3 weeks on topic 2, okay? Let's see how we go. It is flexible, but that is my plan. Topic 3 will be related to topic 2, and we will have some calculations, simple calculations, right? And we might need 2 weeks for topic 2, and the rest 1 week each. Okay, that is the plan. Okay, and before we finish, I just want to go quickly through the so-called mathematical notes, right? Mathematical notes. So, like I said at the beginning, the idea here is that I want to give you an overview of the level of difficulty in math in this unit. Okay? And if you think that what we discussed today is difficult, let me know, because I might need to give you some more refreshment, right? If you think that you are comfortable with what you see today on the slides, it should be fine. Okay, it should be fine. All right, so the starting point is this one, linear equation. Very easy, okay, linear equation. Like I said, we won't go to the sophisticated equations, quadratic equation, exponential equation, logarithm equations, right? We don't need them. We just stay with the simplest one, which is the linear equation. And it's given by this, right? This is a good example. We have the demand equation, right? The demand equation, which says that as long as the price goes up, the quantity will go down, and vice versa, right? Two-way relationship. Okay? And the sign here is negative. Right? The relationship between price and quantity, P is price and Q is quantity. The relationship is negative, meaning when one of them goes up, the other guy goes down. Okay? That is called a negative relationship. And in terms of graph, you can draw a negative relationship using the right figure. Okay? This one is a good representation for the linear demand, correct? It is downward sloping. Downward sloping. Why downward sloping? Because the slope is negative. All right? Good. So yeah, very good. So it should be okay. Everyone should be okay. How about the left one? The left one is upward sloping. It is showing a positive relationship. Okay? And I don't want to waste your time, but the equation is similar. You have y to be a function of x, and here a plus bx, the b has to be positive. Okay? As long as you have the b to be positive, you have a positive relationship. What does that mean? It means if my x goes up, then my y should also go up, right? Because they have a positive relationship. They go together in the same direction. Okay? So just keep in mind, this is a positive relationship, this is a negative relationship. Okay? Next, the magnitude or the slope, right? How much is the slope? It is given by this value, b, right, in my equation. B means the slope, right? If b goes up, the slope will go up, and the line will become steeper, exactly. So if my b goes up in value, in magnitude, in size, then the lines, either this one or that one, they will be steeper. Okay, that is when I have, roughly speaking, stronger relationship, am I right? Or closer relationship. All right, and precisely, whenever it is positive, what I can say is that if x goes up, then y will also go up, right? Because they have a positive relationship. And if b is negative, opposite. If x goes up, y will go down. Okay? Good. And the b here, it is a good illustration, right? Here I have my b to be minus 1, right? Minus 1. The equation is p equals 10 minus q. So my b, value of b, is minus 1. So it means if q goes up by 1, then p will go down by 1 as well. Okay? So b captures how much variations in y following a change in x. Okay? That is also important. So, but at the end of the day, all you need to remember is that two lines, right? Up and down. The left one is a positive relationship, the right one is a negative relationship, right? And just keep in mind that if the size of my b, my coefficient b, increases, the lines will be steeper. That's all. Okay? Okay, and the rate of change is another concept that I want you to understand, especially in topic 3, right? We'll be doing some calculations, very simple ones. Again, don't worry, very, very straightforward. Just like a number going up from 0.5 to 0.51. What is the percentage change? Okay? If you are comfortable with that question, if you can solve that question, if you can give the correct answer, it should be okay. Okay? And here everybody can work that out. Correct? It is 2% change. 2% change. And precisely, it is an increase of 2%. Right? Simply because it's going up from 0.5 to 0.51. So how do I work out 2%? I have the difference divided by the run. Okay? That's all. So 0.01 divided by 0.5. Does that make sense? Good. And now, why I have this equation? Because from time to time, right, we don't always have just numbers. We might need some parameters, right? Interest rate, I just name it I, for example, right? Or inflation rate, I name it something, pi, whatever it is, am I? Then I ask you, if my pi goes up from 0.5 to 0.51, what is the rate of change? You can do the similar thing, am I? But instead of putting the numbers in, you can put the parameters, right? This way. So the rate of change is defined by using the dot. Okay, whenever I have a dot over something, a dot, it means the rate of change. Okay, the rate of change. 2%, 1%, for example. And the good thing about this unit is that we will be talking about small amount of change only. Okay, so the small change, 1% is big. We won't go with 1%. Don't worry. We'll go with smaller numbers. Why so? If you trade currencies, eventually you will see that fluctuations of 1% per day is quite significant. Okay, you can make a lot of money even with 1% change. Right? So in most of the case, you see 0.5% change per day, okay, or even less. Sometimes very stable, okay. But of course, sometimes might be 6% up, 6% down, right? Suppose you have Lehman Brothers story again, right? There will be jump, okay, up or down, I don't know. It depends on what happens, how people translate the information. But 9% per day did occur before, okay. Don't think that 1% is maximum, okay. Sometimes, for example, RBA decided to change the cash rate, you will see a big jump in the value of the AUD. Am I right? If RBA cuts the rate by 25 basis points, for instance, right? I reckon it will see the 6 plus. Okay, it won't see 70 cents. Am I right? You might see that. I don't know, but something like that. Okay, it will be a big jump. All right. So the equation for this is the change divided by the run. Again, the amount of change from moment t to the next moment, which is t plus 1, right? You find the difference. And then you divide the difference by the original amount. Okay, the original amount at time t, that's all. Okay, 0.51 minus 0.5 divided by the original amount, 0.5. That is the equation. But from time to time, I'm sorry, but I have to use notations that way, okay? Because I cannot just put a number to illustrate my point, right? I need to, for interest rate, I need to put I, okay? Leave I, because I cannot put a number. I can be anything, am I? I is different for different countries. So the other way is to use this shortcut equation, right? Delta y divided by y. Delta y means the change in y. But don't worry about it. You don't have to make the same notation. In the exam, for example, there's nothing like this. In the exam, just put the numbers in. Okay, you get full score. This is for illustration. Okay, from time to time only. So don't worry. If whenever I use this thing, I will explain them again. But clearly, this and that, they are the same thing. Okay, they are the same equation. Different ways to express the same thing. Okay, now, like I said, we will be talking about small rates of change, right? Very, very tiny, 0.01%, for example. Now, 0.01% itself is big, okay? If you trade millions of dollars, okay? Still a significant amount of money, correct? But from time to time, when you derive the equation, you will see these instances, right? Where you have the rate of change in S times the rate of change in Y. Sorry, in I. Now, 0.01 times 0.01 is too small, correct? It's a tiny number. You can ignore that. So within this unit, you can use that shortcut. You can, whenever you see that, you know, the product of two small numbers, you can just make them 0. Okay? And don't worry, because like I said, when we're dealing with assessment, exam, for example, we have numbers. Okay? We will know when to use this one. But mainly for, I would say, illustration during week 3 only. Okay? You don't have to deal with this calculation very much. Okay, and when you are clear about the rate of change, then you can do a lot of calculations, right? For example, if you are curious, you know the rate of change in X, the rate of change in Z. And you ask yourself, if I have a product of X and Z, what would be the rate of change for the whole thing, right? For the product. Then the shortcut, the quick answer is that you just add up the two rates of change. That is the answer. Okay? You just add them up. And the reason is this one. Okay? You don't need the proof. But the reason is that I have already employed the idea of small numbers in the derivation. Okay? Whenever I have the product of the two small numbers, I ignore them. And that's why all you need to know is that if you have X times Z as the number you need to find, and if you know the rate of change in X, you know the rate of change in Z, the rate of change in Y is simply the sum of the two rates of change. Is that okay? And don't worry, again, it's for illustration mainly. And likewise, if you have the a ratio, okay, or fraction, or an equation that way, X over Z, right? X divided by Z, then the rate of change of the ratio is simply the rate of change in X minus the rate of change in Z. Okay? Very, very straightforward. And this is a proof in case you are curious. Now, the last thing for today, the demand supply model. Before I move on, any questions so far about these simple concepts? Are they okay? Good. And it will be easier, okay, later on. Don't worry. As long as you ignore the proof, because you don't need the proof anyway, so ignore them. Things will be more and more transparent. Okay, so the demand supply model is also important. In topic 2, we'll be talking about the so-called demand supply model of exchange rate determination. Okay? What determines the value of the Aussie dollar, for example, am I right? And if the government does something, if RBI implements a new policy, how does that impact the value of the Aussie dollar? Okay? Then this model will be useful. And we are going to apply this demand supply model, the basic demand supply model in that context, in the forex market. Okay? So today I'm going to show you the basic elements of the model. In topic 2, we get back to the same model, but in our context. Am I? We don't see some details like this, but we see a more transparent picture and easier to see. But this is the basic model, right? So this one is the demand curve, right? Downward sloping, same idea like before. If the price goes up, the quantity will go down. Okay? The quantity demanded will go down. That is a basic idea of the demand curve, right? A negative relationship between quantity and price. or price and quantity, either way. Okay? From time to time, you will have movements along the demand curve. Okay? It is when the price is changing. Okay? The value of the Aussie dollar, for example, is changing. That is changing the demand for Aussie dollar. Okay? Nothing else. Now, that is one thing. Another thing you should know is that we might have situations where the whole demand curve shifts to the left or to the right. Okay? Depending on what happens. But typically, in economics, we talk about these 6 factors, right? 6 factors that drive the left and the right shift of the demand curve. Now, keep in mind here that the entire demand curve will shift to a different position. Okay? Movement is when you fix the demand curve. You're not shifting it anywhere. You're not changing the demand curve. You stay with the same demand curve. You just go from one point to another, right? One point to another. But now you have the entire demand curve to shift, right? And when does it happen? When you have the income to change, the preferences to change, the population to change, price of related goods to change, expected income and expected future price to change. All right? As long as one of those factors becomes a new thing, right? The demand curve should be a new one. Okay? It should shift the demand curve either to the left or to the right, depending on what happens. Right? For example, let's pick up one of them. Which one do you like? Let's say the first one, right? Income. If your income goes up, let's say we are talking about the demand for a technology product, right? If your income goes up, the demand for the product will go up, right? Of course, not always true, right? Because you might not care about it. For example, if you think about some special good, right? A bowl of rice, okay? In a so-so restaurant, right? If your income goes up, the demand for that might go down, correct? Because you go to a better restaurant, that's all, correct? But here, let's say we have a normal good, right? So, everybody needs it. Coffee on campus, for example, if the price goes up, the demand will change, right? Now, if your income goes up, the demand for on-campus coffee will go up, no matter what happens to the price. At every price level, the demand for coffee will be stronger than before, right? Simply because you have money, more money. Make sense? So you have to shift the entire demand curve to the right to accommodate for the new income. Make sense? So that kind of idea. And of course, other examples will follow based on this list, right? You can explain the similar way. If the income goes down, the demand for coffee will go down. No matter what happens to the price, the entire demand curve will shift to the left. Okay? Will shift to the left. So same idea. And you can explain other factors the same way. Supply side of the economy is captured by this supply curve, right? It is upward sloping, right? Showing again a positive relationship between P and Q, right? Price and quantity. And again, you might have movements along the supply curve when you don't shift it, when you keep it at the same place, right? You don't shift it anywhere. When you stay with the same supply curve, you can go from one point to another point, right? Like that. And in that case, we say that you are moving along the curve, okay? You have movements along the supply curve because the supply curve remains the same like before, right? You're not touching it. There are factors, again, so the reason for this one is simply because of a change in price, right? A change in price. If the coffee price is changing, producers of coffee will change their behavior, right? Sellers may want to sell more, may want to sell less, right? If the government forces them to sell coffee at $2 instead of $4, right? They become so reluctant to do that, right? They will say, oh, we are busy. Okay, so let's quit. Let's quit. The waiting time is 1 hour. Come back 1 hour, you get your coffee. Okay? The delays of production. Okay, they cut down the production. They don't want to sell. Am I right? So the supply, the quantity supplied will go down. Okay, for example, so we move from one point to another along this line. Now, these factors will impact the supply side by shifting the entire supply curve, right? You can shift the supply curve to the left or to the right. Whenever you have one of these 5 factors to vary, let's say technology, okay, we are talking about Bitcoin. Technology, if technology becomes better, right? The machine can make coffee in 2 seconds instead of 2 minutes. Oh, it's fantastic news, correct? Sellers, they will be very happy. They will sell a lot of coffees because they can save a lot of money, correct? So if technology improves, they can produce more for less. They will sell more. Sellers will sell more. Does that make sense? So if that is the case, even the price is the same. Even the price of coffee is the same. Now if that is the case, the entire supply curve will shift to the right. Because sellers, they are prepared to sell more with the better technology. Am I? With the better technology. And the same, right? Number of suppliers. If there are so many sellers in the market, the amount of coffee supplying to the market will be massive, correct? You don't need a better technology. As long as you have other people to enter the market, right? They want to sell coffee as well. Then the supply will change. The entire supply curve will shift to the right. Okay? So if you put demand and supply sides of the economy together, we end up with what we call an equilibrium. Okay? Equilibrium is where demand meets supply. And you have a unique point that satisfies the condition, right, of the equilibrium. It is where you have a unique price and a unique quantity. Am I right? The quantity is also the quantity demanded and the quantity supplied, right? Because sellers and buyers, they are both very, very happy. Now, starting from the equilibrium, like we will do in topic 2, part 3. So anything can happen, am I right? If you have a new information, the market will change, correct? If RBI cuts the interest rate, for example, am I right? Supply of AUD and demand for AUD will change, correct? The demand curve will shift, the supply curve will shift at the same time, okay? But by the way, this is an example, right? Suppose the supply side is fixed. You have something that impacts the demand side only. Then clearly the demand curve will shift, but the supply curve remains the same, correct? There's nothing to do with the supply side. In that case, we have a completely new equilibrium, right? Driven by the change in demand side. Now, in topic 2, part 3, we do this one, we apply this framework to talk about exchange rate determination. But the good thing is, in the forex market, whenever you do something with the demand side, that will also impact the supply side, right? Because look, everybody is pragmatic, right? Everybody is realistic. If you can make money as a seller of currency, and I'm the buyer, right? What's the point for me to lose money? If everybody is seeing the same thing, am I right? We know that the exchange rate will go down because of RBI's decision. You want to sell quickly. Why do I have to buy quickly? I can wait as well, am I right? So if the demand, if supply is changing, demand will be changing as well. So it's more interesting, I believe. It's less boring, is the way I see it. And we see that in topic 2, part 3. Alright, so any question? This is the last slide for today. Okay, good. So again, thanks for coming. I see you again next time.